The average dividend yield for U.S. equity REITs is around 3.9%. So IYRI would then have a way higher dividend yield than traditional REITs.
And our models are looking at a few things when we're rolling those options. It's looking at the volatility of the real estate sector, and it's determining how far out of the money the call should be written and on how much of the notional the call should be written. I wish I had some favorite ones, but I do not. So
this content is sponsored by Neos Investments, which is for educational and informational purposes only and not financial advice. Investors, welcome Troy Cates, the co-founder and managing partner of Neos Investments, where in this video, we're going to be providing a full and complete breakdown of their REIT ETF, that being ticker symbol IYRI, the Neos Real Estate High Income ETF that pays monthly income to investors with also exposure to the real estate investment sector.
Thanks for having me back. Always enjoy coming on here and talking to you and answering any questions you might have on any of our funds. But yeah, thinking about our flagship products, SPYI, QQQI, they've been doing great. Continue to perform as expected given the current market environment. Over the past couple of weeks, we've seen some more volatility enter the marketplace. So that's always welcome from our end. It's not, we don't shy away from, figuring out how the funds can perform best in a volatile market. And then, they continue to raise assets. So that's always a good sign when you have investors showing confidence by continuing to buy the product. So we're really excited about what Neos has to offer right now. We currently have 13 ETFs across our platform, and we're looking to bring out more. So it's an exciting time here.
First question for you, Troy, is what inspired the creation of IYRI, and why should investors be excited about investing in a REIT, but with a cover call overlay?
Sure. So IYRI is our real estate high income ETF. This is an ETF that we look to get out. When you think about Neos as a whole, we really look at ourselves as a solutions provider. And we started out with core equity and SPYI, core fixed income and BNDI, and core ultra short duration or cash alternative with CSHI. And we kind of kept slicing up the asset allocation pie. And we brought out more high income, equity, high income products like QQQI, IWMI. And we really started to move more into the alts as well, whether it's Bitcoin, gold. But we really wanted to get something out in the real estate sector because one, we had people asking us for it, looking to earn income off of their REIT holdings or what they were doing in that sector. And for us, it just made sense to try to bring out a product that could invest in these REITs and a number of names that are in that sector around real estate and be able to employ a cover call strategy over it to bring in income that can be distributed out on a monthly basis.
Tell me more about the case now for REITs, because investors, I feel like, throw REITs out of the table to invest in their portfolio because they look for, SPYI, BTCI, QQQI, but IYRI has been an ETF sector that people should be looking into, just in my opinion.
No, absolutely. I think, for us, when we talk about these products, again, we're trying to offer different solutions. If you have a sector or a portion of your portfolio where you're investing in companies like this, in the REIT sector, in the real estate sector, around the development of any of these types of products, we really wanted to offer this to make sure that you could potentially have income off of that portion of your portfolio. And as you think about what the market's doing, we have the Fed starting to cut rates. We've seen a couple of rate cuts so far. We have another potential cut coming up at the next meeting in December, and then we'll see what happens in 26. But as you start to see rates come in, these might become more attractive to a lot of investors as you think about the real estate market starting to pick up again potentially.
The current yield of IYRI as of October 31st, 2025 is 11.01%. The average dividend yield for U.S. equity REITs is around 3.9%. So IYRI would then have a way higher dividend yield than traditional REITs. So why does IYRI have a higher yield than most REITs in the market? And how does IYRI achieve this double-digit yield?
It's a great question. So if you think about what's in IYRI, so we're invested in the Dow Jones US Real Estate Capped Index. So it's the same index that IYR, for example, invests in. So it's about anywhere from 60 to 65 names in the sector. And as you said, those names on an annualized basis are putting out just over 3% in distribution. So those pass through. So those 65 names were passing through those distributions. So where does the other 8% or so come from? That's where the option strategy comes in. So right now the product uses IYR flex options. I know we've talked about this a lot before, but wherever we can, we try to use index options, but there's no index options on the real estate sector. So we go to one of the larger ETFs, which is IYR, and we look at the options market there, and we trade flex options. And the flex options, I know we've talked about this before, but just to give a refresher, flex options give you the flexibility, hence the name, to change parameters of the actual contracts, whether you're changing the strike from what the current listed strikes are out there, the expiration, or you want to settle European, which is cash settlement, versus American, which the stock could be called away. If you're short calls and it goes through your strike, you don't want to be called away in that scenario. So we use the flex options to have that flexibility. And very similar to our other products, we roll our options on a monthly basis at the end of the month, and duration's a little longer. It's about 7 weeks, going to that third Friday the following month. And our models are looking at a few things when we're rolling those options. It's looking at the volatility of the real estate sector, and it's determining how far out of the money the call should be written and on how much of the notional the call should be written. And that does two things. One, it brings you in the income for that distribution, which is that, as you say, just over 11% on an annualized basis, which includes the 3% coming off the underlying names. And it also gives you the potential to participate if these stocks move higher than the strike price. And what I mean by that is if, for example, right now the portfolio is overlaid on about 75% of the portfolio. So about 25% of the portfolio is not covered by the short calls. So if we had a rally with these underlying names and they moved higher through the strike price, this could potentially still participate because not the entire portfolio is covered by the short calls. So we really want to make sure that we could give you a good total return versus the underlying reference asset, but also bring in enough income to have this distribution on a monthly basis.
Why is 75% of the portfolio in IYRA covered and 25% not covered? Why not like 50%, 60%? So how did you guys come to that figure of let's cover 75% and then leave 25% just uncovered?
No, it's a great question, and it's not static every month. So it's not like every month it's going to be 75%. That changes every month depending on where volatility is and a few other factors that as we're doing the roll at month end, it's telling our models telling us this month it should be 75%. For all we know, next month it could be 65%. We don't know until we go to roll the options on what it's looking at and where volatility's been and where it is that day to say how much of the notional should be covered. But you're right, it can be as low as 50% one month if volatility is very high and we could bring in enough income by only writing on half of the portfolio. Or it could be 80% the next month, depending on where volatility is. So right now, currently, as it stands, it's at 75, but that can change month to month.
IYRI uses flex options and that there's no availability for index options. Is there that tax benefit of Section 1256 for IYRI?
No, unfortunately, you do not get the 1256 contract because the flex option is on an ETF, and it's on an ETF of underlying equity names.
Is there a current dividend yield for IYRI that investors could expect from this fund?
So the goal is to fall within between the 10 to 12% range. So we're kind of right in the middle of the range right now, sitting just over 11% on an annualized basis. But that goal of 10 to 12% is kind of wired into what our model is thinking when it knows the expiration. It's looking at certain deltas of where it should be writing calls, and then it's figuring out how much of the notional it needs to cover. But that 10 to 12% is the goal. It's, there will be times where maybe it doesn't hit that goal or it exceeds that goal, but that's where we're trying to aim for.
In terms of why choosing the Dow Jones, I believe it's the US Real Estate Capped Index, something like that. So why that specific index versus other real estate indexes that you could have possibly chosen from?
We found that this was a widely tracked index. We have a number of partnerships. So it's obviously the Dow Jones, which is part of the S&P family. We have a number of licensing agreements with S&P. And we found that the Dow Jones Real Estate Capped Index, which it really tracks the performance of REITs and companies that invest directly or indirectly in the real estate through development, management, or ownership. So we found that it was a really nice broad-based index, giving you 60 to 65 names within the index that made a lot of sense for the goals we were trying to achieve with this product.
On average, how far out of the money are the calls for IYRI written for capturing upside?
They're usually anywhere between 2 to 4%. And when we rolled at the end of October, one call was about 2.5% out of the money, and one was a little over 3.5% out of the money. But that's usually in the range 2 to 4% seems to be the range we've been seeing with IYRI.
I've noticed that since launch, IYRI is outperforming other popular non-cover call ETF REITs, such as the Vanguard and the Schwab REIT indexes. My thought process was that cover calls underperform their underlying index, such as, real estate ETFs that don't have any cover call overlay. But IYRI with the dividends reinvested is currently outperforming similar ETFs that don't do cover calls. So why do you think that IYRI is outperforming other REIT ETFs?
When you think about what the REIT sector's been doing, year to date or even month to date, it's been pretty flat. So if you have this pretty flat, market, in those instances, most of the time, a covered call strategy, even though we're writing, like we said, 2 to 4% out of the money, can bring in enough income to outperform what the underlying reference asset's doing. So in those flat to down markets, products like ours tend to outperform the underlying because you're continuing to bring in that income and you're capturing a good portion of that because you're not moving higher through the strike prices. That's where you'll see products like this outperform those underlying reference assets.
What's the main benefit of IYRA to an investor already investing in, let's say, a SPYI, QQQI, BTCI? Is it mainly for diversification or just another fund to add from the NEOS family that has a double-digit yield?
I think it's all the above. I think if you're in the space, you're looking for income, you're diversifying your portfolio, you're starting to understand how a lot of these products work. And maybe you're invested in some of our other funds like SPYI or QQQI or some of the others you listed, and you want to get into this space, but you're not sure where to get in, but you want to earn some income. You could see that the REITs, as you were talking about earlier, giving you just over 3%, but you want more than that. A product like IYRI might make sense for you. Diversifies your overall portfolio, giving you that REIT exposure, gives you another source of income. So it's important for us to continue to offer solutions that will fit into people's portfolios. And listen, it's not for everybody's portfolio, but for people looking in this sector and they're looking for additional income or enhancing their income potentially on top of whatever they're doing with their real estate investments, this might be something to look at.
I've noticed that the monthly distributions of IYRI have been consistent and reliable to investors with low volatility in the amount of distributions paid out. Why does NEOS have this consistent distribution payout versus other ETFs in the market? And is this done on purpose?
If you think about what we're trying to do with all of our products, and we'll use IYR as the example, is we have a annual distribution target. So for IYRI, that's 10 to 12%. And if we could stay within that range with how our model works without pushing to the upper or lower boundaries, that is exactly where we want to be. So others, I can't speak for others, but others might be just taking whatever volatility is giving them and paying that out. And when volatility is high, they have higher distributions. When it's low, they have lower distributions, and that's fine. But the way our model works again is it can change how far out of the money we're writing these calls on a monthly basis, depending on volatility, and also change the notional coverage, which is important when you think about it, because in the end, we want to make sure that when this sector moves higher and this market moves higher for it, we want to capture as much of that upside as we can. And if we're constantly selling, say, on 100% of the notional or closer to the money and taking advantage of that volatility just to have a larger distribution, we're potentially going to miss out on the upside move when it happens. So we want to be positioned for that move, but still provide a good amount of income on a monthly basis and hit that annualized distribution target.
I'm assuming that Neos individually holds every single REIT and doesn't just invest in IYR ETF.
Correct. So for this one, it makes sense to hold all 60 plus names. It's not difficult for us to do that. Even in SPYI, we hold all 500 names in the S&P 500, or QQQI, all 100 plus names in the NASDAQ 100. So it made more sense to do that than to hold the actual ETF. There are some funds we manage where we hold an ETF just because it gives us such a broad access to whether it's the Russell 2000 versus owning all the Russell 2000 names, or some fixed income names instead of buying the individual fixed income products and owning thousands of fixed income products. We might own an ETF in that scenario.
Do you know how the top holdings are chosen versus other REITs in the fund that are lower weighting? So how does Neos choose which REITs are the top holding, like top 10, versus ones that are like in the 20s, 30s, 40s, 50s, 60s?
Again, we are tracking the Dow Jones U.S. Real Estate Capped Index. So when they reweight, we reweight. When they add or delete a name, we do the same. So if you look at our top 10 holdings, it should be very similar to, say, IYR, which tracks the same index, the Dow Jones U.S. Real Estate Capped Index. So we are just tracking that index. And we're not making a determination of, oh, we think this REIT is better, let's move it up the list and have a higher weighting on it. We're really leaving that up to the index team at Dow Jones and S&P to really build that index out to what they think is the optimal weighting. And then we just track it from an underlying perspective. Similar to all the other products we just talked about, QQQI, we are just tracking the NASDAQ 100, SPYI, tracking the S&P 500 from the underlying equity standpoint.
In October, there was an 84% return of capital estimation for IYRI. Can you explain what is return of capital for beginners, why a large percentage of the distributions are classified as return of capital, as well as more return of capital better or less return of capital better for investors?
So I believe you're referring to what is known as a 19A1 notice. And those notices, because we have a monthly distribution, need to be put on our website from our fund administration, and it's an SEC rule to have it out there. Now, those numbers aren't exactly what the return of capital will be. It's a potential of what it could be. So the real numbers will not come out until January, when our fund admin, who's US Bank, and fund administrator go through all the numbers for the entire year, and then determine what was potentially any qualified dividend income, any return of capital, any long or short-term gains. And they build that out for the 1099s that then go out to all the brokers and then are disseminated to all the shareholders. So you get that 1099 from your broker at the end of January or early February, and you pass that along to your accountant so you can make sure you're paying the appropriate taxes from the year before. So for us, really looking at the return of capital structure. And I know we've gone through this before. And for us, it's really important because it's part of what we talk about when we talk about tax efficient income. And yes, a lot of times we're talking about index options. And in this case, there are no index options for this product. But if there potentially is a return of capital component this year, which we won't know until January, but if there is a potential of return of capital, we're not trying to return principal. We're trying to use the IRS designation of a return of capital, which really just lowers your cost basis and defers your taxes down the road. So instead of paying, say, an ordinary income on the distributions you receive this year, you could potentially defer them down the road and pay a longer term cap gain or a better distribution or a better rate than what an ordinary income would be this year. So to give you an example, since we have last year's numbers, SPYI, for example, last year, the products was up over 19% in 24 total return. We distributed out about 12% of that 19. So it still had price appreciation. It had total return distribution throughout the year. And out of that, call it 12% distribution, there was just under 94% of that was deemed a return of capital. So from an IRS perspective, when you get your 1099 and it says you have a return of capital, you're deferring those taxes down the road. You're not paying any taxes on those distributions in the year you receive it. What it does is it lowers your cost basis and defers it down the road. If you decide to sell the ETF, you'll have a little bit of a lower cost basis, but if you held it for longer than a year, you're going to pay a long-term cap gain. Or if you decide to hold the ETF for a very long time and you exhaust your cost basis to zero, in that scenario, you'll be paying long-term cap gains on the distributions going forward. So in our view, it's a way more tax efficient way to keep the money that you have and continue to let it compound until you decide to either sell the product or you exhaust your cost basis and you start paying taxes on it.
What do you think are the main risks of investing in a REIT, for example?
Listen, there's risks in investing in any product in this market. So when you're thinking about the REIT sector, there's always interest rate risk. There's risk to the underlying REITs. Like I said, we're holding 60 plus different names inside the portfolio. So there's definitely risk to those underlying names. And of course, there's sector risk. If suddenly we start to see issues in the real estate sector or the REIT sector itself, there could be risk to what you're actually holding as the underlying holdings. And what does that do? Do we see a sell-off in those names and volatility moves higher? In that case, maybe we're bringing in a little bit more income, or maybe we're able to write further out of the money and on less of the notional. So when the market does turn, we could participate with that upside. So for us, it's really not telling anybody that they should invest in REITs or this sector or this ETF. It's just offering, again, that solution to say, here's something that you might already be investing in, and here's a way to potentially earn additional income, and additional income stream from distributions off of it.
What are some common mistakes you see investors make that look to or are investing in REITs? Because to my knowledge, I've seen investors just look for the highest yielding REIT and then they're buying it. I think for REITs back in the day, that was the best way to, I guess, look for the highest dividend yield. 3%, 4% yielding range, in my opinion. So what are some mistakes you see investors make that buy REITs?
We've seen or talked to people that we just pick names because they were either the largest or the best yielding. And in some cases, that's not always the best way to go about it unless you really understand what you're investing in as far as an individual name and picking one or two or three names out of, a number of names. That's always a tough kind of analysis to do in this sector. But if you understand the sector or you work in the sector and you know a lot about the different companies in the sector, then maybe you're a little bit more knowledgeable about it. I think for most people that want to get involved in investing in this sector, of course, we're going to say look towards an ETF. They're more broad based. You're going to get access to a number of different REITs. Then you can have a broader portfolio to invest in. And that goes the same across any sector as you're thinking about investing, period. I always tell people, from my opinion, to look at ETFs first. See if there's a broad-based ETF that can kind of cover what you're looking for, whether it's REITs, growth, or just broad-based index exposure, and then work your way backwards. And then maybe you start to pick some individual names that you might like more than others.
There's always this statement of, why would I invest in a REIT when I can just buy physical real estate and maybe get some income off of that? So what are your thoughts on people saying, I'll just buy physical real estate versus a REIT, and then those just wanting to buy a REIT versus physical real estate?
Listen, I think there's always a place for physical real estate in your portfolio. And if you have the liquidity, maybe it's just your first home, maybe it's a second home, maybe it's just an investment property that you're renting out. I think there's always a place in that alternative bucket of your overall portfolio. But for some people that don't have that liquidity or can't make that leap to buying that first investment property, looking at an ETF that gives you exposure to the REIT sector is probably the next best thing. And when you think about it, the liquidity of an ETF, if you're long an ETF and you decide to sell it the next day, it's very easy for you to get that liquidity. Whereas if you're long an investment property and you decide to sell it, depending on where it is in the country and how it's priced, that could take, days, months, years, depending on where you're invested in. And so the liquidity is an important thing, especially within ETFs. If you could buy something and change your mind the next day and get out of it, that's usually a better situation for people. But I always believe there's still a place for actually owning or having investment properties outside of just your equity book portfolio or online portfolio.
Why do you think that REITs have been not performing the best as of the last couple of years? Is it because of the high interest rate environment? And could lower rates potentially benefit this sector?
I think that's, I would probably agree with that. I'd say, listen, rates, if you think back a few years ago in pre-COVID were as close to zero as you can get. And people were buying homes with mortgages in the 2 and 3% range. And now it's more than 2 or 3 times that. So it's definitely, rates have gone up. They're starting to come back in as we've seen the Fed start to cut, a quarter of a point here, a quarter of a point there over the past couple of meetings. And we have one more meeting in December. So we'll see what happens going into the end of this year. But I think when it comes down to real estate, yes, a lot of it goes around where interest rates are and what people can afford. And whether it's that first time home purchase, and now you're looking at a 6 to 7% rate compared to a few years ago when it was 2 to 3%, that's a huge difference on your monthly bill. So when you think about that from an investor standpoint, if it's buying another property to invest in and what they need to put down versus what they could borrow against and what that rate looks like, that might change what their rate of return looks like and how much they want to invest, or do they want to invest in that building or that home, or that multi home process. I think as rates come in, we should start to potentially see a pickup in this sector overall, which could be good for the sector.
The top REITs in IYRI are Welltower coming in at number 1, followed by Prologis, American Tower, Equinix, Simon Property Group, Realty Income, a fan favorite from a lot of investors, Digital Realty Trust, CBRE Group, Public Storage, and Crown Castle, rounding up the top 10. I want to get your thoughts on what are some of your favorite REITs that are within IYRI, if you have any favorite ones.
I wish I had some favorite ones, but I do not. So I can't talk about individual names, but I will say that the sector we're tracking, we're very happy with it. We're very happy with the index that Dow Jones and S&P have put together for this U.S. real estate capped index. And for IYRI, it makes, for us, it makes a lot of sense to track this index and get exposure to these larger REITs and these companies involved in the space, and then employ what our expertise is. Our expertise is not picking individual REITs. It's picking how to put an option strategy on top of different sectors of the market and then be able to provide income off of the volatility of that sector of the market.
I'm assuming you also own IYRI because you also own SPYI, QQQI, BTCI, and all your NEOS products.
Correct. So Garrett and I, as the two PMs and co-founders here, we own all of our products. I don't know what his portfolio looks like. I just know he owns all of them. But for me, yes, I own them all in different weightings. And I think there's a place for this in your portfolio, and that's why I own it.
I also want to talk about other ETFs that NEOS offers that could maybe benefit some sort of real estate investor that wants to buy a home one day. So I was looking at CSHI, which is the NEOS Enhanced Income 1 to 3 month Treasury Bill ETF. So why should investors be thinking about, investing in cash given the higher rate environment? And what's the investment objective of CSHI?
That's a good question. And we launched this product in August of 2022. And if you remember back in 2022, what the market was doing, very rough equity markets. And towards the end of the year, a lot of people were pushing money towards ultra short duration or cash-like products. And it definitely benefited CSHI getting that product out early. It was the one out of our first 3 that we launched that started to get some first initial AUM, which was exciting for us as we launched the business. But CSHI, the underlying of it is the 1 to 3 month T-bill. So the portfolio has a basket of 1 to 3 month T-bills, and then it has an option strategy on top of it using S&P 500 index options, where we're selling put spreads and rolling those on a weekly basis to bring income in. And we thought about building this product mainly because we were looking at the time, interest rates when we were building it were close to zero. And we were saying, how can you have an ultra short duration portfolio, 1 to 3 month T-bill portfolio, so like a cash type portfolio, and get a little bit of income off the volatility of the S&P 500, an uncorrelated index, give you additional income on top of that. And so we're in a very conservative put spread strategy where we're bringing in income on a weekly basis to add to your whatever the 1 to 3 month T-bill is doing. So right now, that is giving off anywhere from 1 to 1.5% of option income over whatever the 1 to 3 month T-bill is doing, which is currently just under 4%. So right now, as of the end of October, this is yielding just over 5%. My view is as rates start to come in, we'll see the rates of those 1 to 3 month T-bills start to come in more. And they have been coming in as rates have been cut. But as rates start to come in, this might be a more attractive product because people are going to be sourcing yield and looking for yield in other places. But in the end, it's still a low vol, more conservative portfolio than maybe investing in some of our other high income products. We've had a number of people use it to put cash in there and park it for a little while, earn whatever the 1 to 3 month T-bill is doing, plus the added option income, and then maybe deploy it someplace else. As people were used to the past couple of years of having these ultra high-end savings accounts that we give them 4.5, and at one point close to 5% in interest. I think as rates start to come in and they're not getting that anymore, CSHI, for my opinion, looks like an attractive product. You're still getting that 1 to 3 month T-bill security, but you're adding the option portfolio on top of it, which will introduce a little bit more volatility, but not much. And you're getting that added income on top of that.
I also want to touch on another ETF that could also benefit from rate cuts because we know that IYRI may benefit. But what about a small cap ETF? I know you guys have IWMI, which is your small cap ETF based on the Russell 2000. What makes you excited about that ETF? Because I know a lot of investors like the yield from that one.
Yeah, we launched that in June of last year. So just over almost a year and a half of a track record in our IWMI. And being the Russell 2000 high income ETF, what are we doing there? As we were talking about earlier, this is one of the ones where we use an ETF to get exposure to the Russell 2000. Instead of buying all 2,000 names in the portfolio, sometimes it's difficult as you have flows come in to allocate appropriately across all 2,000 names in the proper weighting. So what we do is we buy an ETF to get the exposure to the Russell 2000. And then we're using Russell 2000 index options, use a laddered short call portfolio to bring in income, similar to SPYI or QQQI. Again, we're able to use index options for the Russell 2000. And with this one, when you think about the small cap exposure you're getting in the Russell 2000, exactly what you're saying. As rates start to get cut, usually the small caps start to pick up a little because a lot of these small cap companies rely on borrowing money for their growth. And when they're borrowing money at lower rates, they're able to borrow more. And hopefully the idea is they could grow more through that borrowing and what they need to do with their businesses. And when rates are higher, these are the ones that tend to have a more difficult time because they can't borrow at the same rate or the same amount they used to be able to borrow. So we'll see as rates start to come in if this sector starts to pick up a little more. But there is more volatility in the Russell 2000 than we even see in the NASDAQ 100 sometimes. So you can earn a little bit more income, which is paid out in a monthly distribution from the Russell 2000 versus some of the others. So it's a product that has definitely caught on. And I think a lot of people look at it in the sector and say, if I want that exposure to those small caps, I want to earn income off of those small caps while I'm holding them, this might be one to look at.
I want to talk about the NEOS trading team specifically. So how does the NEOS team manage IYRI on a daily basis for long-term success? Because I know a lot of other ETF issuers outsource their trading team and all their trades, but to my knowledge, you guys do it all in-house. And what makes that unique and special for investors to trust NEOS with the cover call overlay and just managing their money in your guys' ETFs?
That's a good question, Marcos. I think when you think about NEOS, we have over 30 people working here across all departments, but our trading team specifically, there's 3 traders, and they've all been in the business well over 20 years and have a really vast knowledge of trading most asset classes and most derivatives. And when it comes to everything we do here, from research and development to the actual implementation and trading of our products, we do that all in-house, as you said. So having a trading team that has the knowledge and the relationships to be able to manage these products on a daily, monthly basis is really important to us. And it's something that we knew we wanted to do from the ground up when we started here, because we wanted to make sure we weren't outsourcing. And it's fine for other firms that want to do that and have people sub-advise their products. But for us, it made the most sense to do everything in-house. So how do we manage things on a daily basis? Most days as we come in and they're kind of going through and making sure any trades looked good from the night before and make sure everything is as it's supposed to be in the holdings files before the market opens, because those holdings files, which are on our website on a daily basis, are important for the market makers, because the market makers will look at those holdings files and say, all right, how do we make a bid and an offer given the underlying basket of this ETF and what the options look like and what the underlying equities look like and so forth. So it's important for them to make sure that everything looks right. But on a daily basis, if we start to get flows into the fund, say we start to have investors out there buying, what happens is one of the market makers will do what's called a creation. And our creations are done in 10,000 share blocks. So let's say a market maker has investors coming in and buying, and then the market maker is getting short stock. And in order for that market maker to flatten out their book, they could either go buy it in the market, or they could do a creation through what's known as an authorized participant. So the AP, which is usually the larger banks, they put in to do a creation. One unit would be 10,000 shares. So let's just assume they're short 10,000 shares and they want to flatten out their book so they're not short overnight. They'll do a creation, and that creation will come into us. We'll see that a creation is coming in. And usually the creations for, say, an IYRI are delivered in kind, meaning the underlying equities are getting delivered directly to us. What's not being delivered to us is the option position. So we will see that one creation come in. Our trading team will look at it and size up what they need to do on the option side. How many more short calls do they have to add, if any? And then we'll execute those towards the end of the day. And they'll execute it with one of our brokers. It could be our lead market maker, it could be our prime broker, or a few others that we work with. And they get that execution done towards the end of the day. And they send that to US Bank, who's our fund admin, fund accounting custodian. And they take those new positions along with whatever was delivered in kind from the authorized participant, from the market maker, and they add that to the holdings file. That's why our holdings file, if you were to pull it up on neosfunds.com, those holdings files can update on a daily basis, because there could be position changes, whether we traded something in or out, whether we rolled the options. But that's how it works from a creation standpoint. The busier days for the trading team are weekly rolls for all the fixed income products. We're rolling all the short put spreads that we do in, say, CSHI, like we were just talking about, or TLTI, BNDI, HYBI, and then the end of month roll for all the high income or alternative products. So that's when we're rolling the short calls, say, on IWMI or IYRI. And when we're rolling those short calls, we're closing out all the old positions and at the same time rolling 1 month further to the new positions. And that's when our team on the trading desk and Garrett and myself as portfolio managers are looking at the model and saying, we should be in for IYRI, we should be in these 2 different strikes at this expiration on this much notional. And they're closing out the old positions and rolling into the new ones. And so those are the busier days for them.
The expense ratio for IYRI is 0.68%. What goes into that expense ratio figure that investors are paying for? Because traditional REIT ETFs are about, less than 10 bips, for example. Your fund, IYRI, does have that cover call overlay and that additional yield.
Yeah, so when we price things, thinking about where we are at, 68 basis points, very similar to where we are in SPYI, QQQI, across our high income equity products, we wanted to stay in that range, which is right in the middle to even to the lower end of some of the active products. So when you were referring to the other real estate products out there, those are all passively managed equity products that don't have an option overlay. So that option overlay does add a piece of work that we're doing on our side on top of all the, call it research and development into bringing that product out. And then it's also active. So we're not passively managing something where There's really kind of hands off outside of any big index changes. This is, as we kind of just walked through, a daily, a weekly, a monthly management of the option strategy to make sure it's doing what we set it out to do.
Thank you so much to Troy Cates, the co-founder and managing partner of Neos Investments. Now, if you guys want to learn more about IYRI, you guys can at neosfunds.com. Now, if you guys like this video, please give it a like because of this cute puppy did. Thank you guys so much for watching. And now, once again, this is not financial advice. We are not financial advisors. Do your own research. Investing involves high risk. And I will see you guys on the next one.